We're going to go ahead and start. First off, I want to just welcome everybody into the 2018-2019 Advanced Health Plans User Group meeting. We try to do these every year. I'm Jay Kempton with the Kempton Company. We're the administrator of Advantage Health Plans Trust, and I have Maria Robles Myers here next to me, and she is actually the Trust's legal counsel and advises your board of trustees on all things compliance and Affordable Care Act and ERISA, and keeps us all out of trouble. We are also joined not only with the folks here in the room, we actually have about twice as many participants joining via GoToWebinar, and so that's what all the gear in the back is. So we have several of our Oklahoma bankers, plus many of our Texas bankers are joining us online. And so just a housekeeping comment I want to be sure and make is if you are joining us online, there is going to be a question and answer section toward the end. And obviously if we're here, when we open up, we'd love to take questions and answers because this is your plan. You all are the owners. We work for you guys. But those of you all online, you'll be able to submit your questions in your into your GoToWebinar user interface. There should be an area there that it's either, I think it's either labeled comments or questions that you'll type in, and then we'll read those back to the audience. So we're going to go ahead and start. And we're doing a little bit disjointed. Megan is going to have to read my mind in the back on when I switch my slides here on my iPad. But I did switch, Megan, so I'll try to look your way when I switch. We're very pleased to announce that Advantage Health Plans. We look forward to this every year, but this is really a special year because this is kind of a all good news type of presentation today. And we're not going to wait like your mom made you wait till the end, wait for dessert to after you eat. We're going to do all the good news up front. And then as we move forward, we're going to reflect on some of the things that brought us to this good news, because I think we all deserve kind of a round of applause on a job well done, starting with you all and your employees. But the good news, first item of good news is not only is Advantage Health Plans the preferred health plan for the Independent Community Bankers of Texas, also the Community Bankers Association of Oklahoma, but new to announce is Advantage Health Plans was also chosen by the Independent Bankers Association of New Mexico. And so some of the Kempton team members and some of the AHP board members have spent some good quality time in Santa Fe this last year, working with the insurance department there, getting the plan licensed, and then also attending their annual banking convention with the ICBA of New Mexico. And they are a great bunch of community bankers out there. They are a very, very tight-knit family, and I think that they'll be an amazing addition to your health plan. Some of the topics that we're going to cover today, the very first is going to be the plan performance update and the renewal information. The Board of I keep referring to the Board of Trustees. If we have any AHP board members or past board members in the audience, would you all raise your hands? Very good, very good. Now you're an associate or an advisory, so you're full now. That's right. You're due shy, Sandy. But anyway, but when we keep referring to the board worked very, very hard to try to move the renewal process up in order to get the renewal information and the bucket changes back to you all more timely, more quickly. And so that took a pretty good shift working with our consulting actuary to shift that, but we're very happy that we have been able to achieve that. We're going to give you the renewal information here in a couple of slides, and then the actual renewal letters to the individual banks we're hoping to get those out either next week or the following, before October 1. where you all will know your final rates and everything for 2019. So we're going to go over plan performance, update and renewal. We're going to talk a little bit about some of the 100% benefits, and we've changed the Kempton Premier Providers, as you all are very familiar with. We're kind of shortening that to just KPP Free. So we're going to talk a little bit about some KPP Free updates and some statistics around that. Some 2019 benefit changes. And we're also very happy that all of the 2019 benefit changes are all enhancements. So that's great news. Then the next section is going to be protecting your plan. We've got some useful tips, some cautionary tales that we've seen either in the news media or actually from some of our bankers. And we've got a lot of, I see that we've got a few CEOs, but we've got a lot of HR folks here. The purpose of that section really is for you all to take that information back to your employees and educate them, because the ultimate goal here is that we don't like surprises, just like you all and your employees don't like surprises. And so we try to give as many tools up front where people can kind of be forewarned and more knowledgeable, where they can make educated decisions and not have negative surprises when it comes to the plan. Maria will then give a brief legislative update, and then we've got some new news on the employer web portal, the Healthcare Bluebook challenge, and then really questions and answers. Does everybody remember seeing the information on the Healthcare Bluebook challenge contest that we're running? Okay, very good. So we are going to draw a couple of winners for that at the end of the presentation. Okay, so just a recap on some AHP details. I don't know that a lot of our bankers are aware of some of the details around AHP and kind of the status of your plan. But in Oklahoma and Texas, we're doing business now with 128 member banks across those two states. The number of employees that are part of Advantage Health Plans Trust, we have 2,900 individual bank employees that are on the plan. When we add in their dependents and spouses, the total number of individuals that are covered by Advantage is, as of June 30, was 5,600. Your trust fund, and I keep saying your, which intentionally, because this is your money. It's not Kempton's money. It's not the board's money. It is all participating member banks. But your trust fund is sitting right at about $13.4 million now, which is up considerably over the last few years. So that is there to just help hopefully maintain low and budgetable increases if they're needed over a long period of time. In the last July 1 through June 30 of 2018, your trust has paid out about $26 million in benefits, medical and prescription benefits, to your employees and their dependents. Now, the great news is the 2019 trust level increase is 0%. That is not that was not a sharpen the pencil till the lead breaks decision there. It was that is a very conservative renewal adjustment of 0. The actuary said that you would be safe anywhere between a very, very small increase to a small decrease. And the trustee said, things are very good. We're still profitable. We're still able to provide a stable rate to the member banks, continue to build reserve. And so they voted to go ahead and put in that 0% increase. Now, down in the fine print, I just always have to remind our bankers, and you all are all smart and savvy Advantage Health Plans members. You all know that the trust level increase is one component in what ultimately determines whether or not your individual bank's rates are going to go up, down, or stay the same, right? Everybody kind of remember how the bucket system works. If your bank is staying at the same risk category, the risk bucket that it was in before last year, if that isn't going to change, then your increase is whatever the trust level increase is. So to kind of break that out into a distribution, we see that about 65% of the member banks within Advantage Health Plans this year are not going to be shifting risk categories at all. If you all will remember this time last year, we had another great year. I think we had a 1.5% overall trust level increase, and the board voted to freeze the risk categories. So not shift anybody. It doesn't mean that there weren't banks that probably needed to be shifted either to a higher risk category or a lower, but it was decided just to freeze that last year. This year is kind of the opposite is happening. If you think about it, the trust level increase is 0, but the board and the consulting actuary felt like it was probably prudent to go ahead and recognize the individual banks. If your bank's risk is staying about the same, you're going to stay put. If your risk has been increasing over the last couple of years, then you're going to see that increased bucket shift. And about 23% of the member banks are going to be moving to a more risky risk category. So whatever the value of that shift is, if it's 5%, then your bank would get that 5% risk adjustment plus the trust level increase, which is 0. So your bank would be getting a 5. 12% of the banks are actually getting a risk category reduction. So whatever that risk category reduction is for a bank that's getting that negative shift, then they'll actually perceive a risk or a rate reduction for 2019, and 12% are getting that. Any questions on the rate adjustments and the risk categories? That's, you all hear this once a year, and so if there's anybody that has any questions, we can sure address them right now. I know. I'm waiting for.
Very thankful, and you see what's happened the last several years, which is just where we wanted to be going. So.
Absolutely.
We're a hard group is what I'm telling you. I'm sorry. Keep talking.
You're kind of like your board members.
You got a question?
Yeah. Yes, sir.
So the 23% have lower risk.
Have higher risk.
Will have higher risk.
Yes, their risk is increasing. Yeah, and so they're going to, the philosophical way of looking at this is roughly 23% of the banks are being subsidized by the other banks. And so because of that, they're going to be asked, at least for the time being, to make higher contributions to the trust.
Okay, so 23% higher, 12% lower, than 63% will stay the same.
It's the same. You got it. You got it, Stan.
You got another one in the back?
Yeah, Robert.
Those that do decrease, how far can they decrease?
Great question. The board and the consulting actuary work together that no bank can move down or up more than one risk category in a year. And that's the overall philosophy of the trustees is to squash out volatility. We don't want any banks getting a 40% premium increase in 1 year or a 40% decrease, even though the bank getting that would really enjoy it. But really to try to smooth out those bumps.
So what's that percent amount to just one?
It depends on what category we're talking about, and it's kind of actuarial math. But if you are in a low risk category right now, like a -5 risk category, and you're moving up to a -4 risk category, the percentage, because you're dealing with smaller numbers, the percentage is going to be higher than if you were moving from the 0 risk category to the +1 category. So I think, if I'm remembering right, I think the biggest jump is at like 14%, 16%, thank you. So the largest step value, what we refer to it as, is 16%, and I think the lowest is somewhere 3 to 5%. Yes.
You want me to throw it at people?
It's what it's made for, actually. AB, you want to grab this box here, and if anybody has a question, this is kind of fun. It's like a big Nerf box microphone.
That's scary.
Yeah, they're
You
fun.
can just see me hitting somebody. It might be useful next year to have a slide that shows the rates, the percentages on each step. so that because it's hard to visualize.
It is hard to visualize. Okay, next slide, if we don't have any more questions. This was something that the board actually recommended that we have this on a slide. And this actually comes from Milliman, which is, they're a global consulting actuarial firm. And your trust fund writes a big check, a 6-figure check a year to Milliman. They're the really smart guys in the room. But this is something, this information comes out on every renewal analysis that your board reviews. And what this is showing, a lot of things we get in that renewal analysis, but this is a component of that. And what this is showing in the red bar chart there, is for other employers that are in the financial services industry, just like community banks, what does Milliman see nationwide as the average cost to provide benefits on a per employee per month basis within this industry versus what does the actual cost to provide benefits, the actual contributions that the bankers contribute into the trust fund for Advantage Health Plans Trust on a per employee per month basis. And so we can see this, that going back to 2014 all the way up to 2019, you can see that the Advantage Health Plans contributions on a per employee per month basis are much more stable than what Milliman is seeing out there on the open market. And that is, as you know, Alicia, as you mentioned, that was the goal, 7, 8, 10 years ago when we were talking about, engaging the bankers to be more savvy consumers and everything else. The goal here was for the trust to outperform what you all would be able to get out on the open market. So this was a great slide for us to illustrate that, again, we are achieving that goal. And when I say we, I mean you. Okay, next slide. And this is an important thing I think that the board would also want to make sure that you all hear is when we look at these contribution levels that we've had some very favorable renewals when it comes to setting next year's contributions. But that's not being done in an imprudent fashion where, well, maybe the actuary thinks we need to have a 5%, but instead we're going to have a 1.5%, we're going to burn off reserve. That's not what's happening here. So while we've had very stable, very favorable renewal increases, you can actually see what the total trust assets have been doing at that same time. They have been increasing steadily over the last few years, and those dollars they don't ever leave the trust. The only way that they can leave the trust is either through benefits being paid out to the member banks, or through some sort of a premium holiday or something like that. The board right now is their overall goal is to be able to provide very level, stable, small premium increases over as long as we possibly can get. If they can keep the renewal increases to be single digit for the next 10 years, that's what they want to try to do. And so they feel like, again, continuing to accumulate healthy reserves just helps stabilize those rates. And if we can do it while also having close to 0% or increases in contributions, then I look at that as a home run. I think you all would too. The line that you see there is reserves required by law. That's something that we don't really talk about, but Advantage Health Plans Trust is, association health plan legislation has been in the news probably ever since President Trump was elected. Everybody has kind of heard of association health plans. It's kind of a buzzword that's especially out in the benefits world these days. Advantage Health Plans is probably the original association health plan, at least in Oklahoma. And it's always been run like that, and it is a licensed multiple employer welfare arrangement in Oklahoma, Texas, and in New Mexico. And since we are licensed, there are minimum reserve requirements in each one of those states. And this kind of shows you all where the statutory requirements are versus where your trust sits. Again, being run by high quality community bankers. They run your trust very, very conservatively. Any questions at that point? We're getting ready to move to the next section. Okay, very good. Talking about 100% benefits, KPP free, and some other updates. These are just some advanced health plans, premier provider statistics. I think this is a good recap for everybody because it also, you all will probably remember the first time that I stood here. I think we probably had Dr. Keith Smith here that very first year talking about that crazy, upfront cash pricing concept with Surgery Center of Oklahoma. That was back in 2012. Boy, have things come a long way. But since really the trust really started kind of utilizing, we got it completely implemented, the concept back in March of 2012. So that first column up here is from 2012, 3/1 of 2012 through June 30 of 2018. Advantage Health Plans, your trust has had 7,100 procedures that have been done through a premier provider. And those are, again, you all know how it works. Your employees are voluntarily choosing to seek higher value care, lower cost, high quality care through one of these premier providers. Overall savings from inception, which was 1/1 of 2011 through 6/30 of 2018, is about over $14.5 million saved. And the way that we calculate that number is we look at what is the average cost of one of these medical procedures through the PPO network. Where are we generally buying, say, a pacemaker or a colonoscopy? Where have we generally been buying that, and what is the amount that the plan would have paid versus what did we actually pay when we utilized a premier provider? And that delta has accumulated to about over $14.5 million in that time frame. The average amount saved per those 7,100 procedures is about $2,000 per procedure in savings. The lowest dollar procedures that we see out there are generally going to be things like mammograms, MRIs, and things like that. Small dollars, but there's so many of them that they really, really add up. And so that kind of swings that average down to the $2,000 per claim saved. The highest amount of dollars that your trust has saved on a single claim that was redirected to a premier provider is $153,000 on one procedure, and the patient actually got care and still saved $153,000. The last item is these cash price agreements. We've done 110 cash price agreements since inception. You all remember what a cash price agreement is? It's really that advanced degree in consumerism. It's where you all have a member of your bank that has been given the premier provider price for a medical procedure that they need, and then they're taking that price and having a conversation with their local physician, their local hospital, and that hospital is stepping up to match the price of that premier provider. I mean, that is the execution of consumerism at its finest right there. That is what you call an empowered healthcare consumer. And when that happens, we treat that situation exactly like any other premier provider engagement. The plan pays that medical provider at 100%, but they are not a full-fledged, transparent-minded medical provider, but they've chosen to compete to maintain your employees' business and not lose that case. That right there, folks, is probably the biggest indication that we are changing the way your employees think about buying healthcare. So, I mean, that is love that. 2018.
Can I
yeah,
interrupt you
absolutely,
for a
Maria.
minute? I think the one item that is not ever mentioned is when you look at the savings of 14,775,000, that's what the plan saved. But what it doesn't really tell you is that shifted zero cost to the employees of the participating employers. Whereas the healthcare normal stuff, the deductibles have gone higher and higher, which means your individual out of pocket, the cash out of your checking account gets more and, more and more each year. These procedures have brought it down to zero. So when the savings is to the plan and the savings is to the individual, they need to understand that when they're using this, they're not paying anything at all.
And that's a paradigm shift, because
really-
historically,
yeah.
for a plan to save money, I mean, how was a plan able to save money before? By shifting additional cost onto the employee's independence. In this model, you all know this, but the plan is able to save so much money that we're able to share that savings back to the employee or the dependent in real time. So yeah, that's a great point, Maria. Thank you for bringing that up. Yes, sir, Ty?
Do you all, whenever you're looking at switching banks from bucket to bucket, is there acceptance or their usage of these premier providers, is that taken into consideration at all?
Kind of on the fringe. That what you're saying is good behavior taken into consideration. It is if there's a situation where, I mean, we're on the razor's edge, between a bucket shift, to the negative or to a bad shift. If we see that the bank is really doing some, they're doing a lot of education, we're seeing a lot of buy-in, then the administrator has been given a one bucket leeway or discretion on those. And if we do see that there is, for lack of a better word, good behavior or good intentions there, we do try to take that into consideration. But it's only if we're talking, it's a flip of the coin or right on the edge.
We'd like to get some more out in our area. We've lost some, like people that do MRIs and things like that, so I was just kind of curious about that.
Yep, absolutely. In 2018, just real quick, just for 2018, we've done 1,006 KPP-free procedures, 1.7 million saved, averages $1,759 per procedure. The largest single amount saved on a claim is $92,000. 26 cash agreements just in 2018. And then to get back to the previous question, we are, what started off with one provider, we now have 82 free market facilities in 11 states that have essentially decided to step across that line and compete directly for cases by being transparent with their pricing, transparent with their quality. Of those 82, some of those have actually multiple locations or several imaging centers that have multiple locations, branches, if you will. So there's a total of 156 individual locations. We have 2,500 imaging centers, though, around. So if you don't have one, you guys are in, it sounds like we've got a hospital that has come in and bought everything up. Because we do pair one call imaging is seen as a Kempton Premier provider, and so we've kind of blended those two together, so that's how we're able to have those 2,500 imaging centers all paid at 100%. We have over 100 prospects, though, to look to become a Premier provider. We actually have more than we're able to follow up on a timely basis. We've actually have got 4 full-time employees at our company that are in a provider relations department. That is what they do, but they are being called on a lot more than they have time in the day. So this concept is catching on, not just with us. I mean, one of our missions also is to kind of change healthcare from the inside out, and so I do a lot of speaking nationally to my competitors, to other medical providers in multiple states to try to get more of this, because this is, we like to term the phrase is what you all are doing here in Oklahoma in the community bank sector. You all are kind of embodying what we like to call DIY healthcare reform. And we're trying to, again, spread this around the country. We're doing right over, a little over 600 Premier provider redirections now every month. So it is becoming, as opposed to a fringe concept, your employees now, when they're calling the benefit plan, generally the first question they ask, it used to be, what's my deductible? Now it's, can I get that done with a KPP? I mean, that's usually the very first question that's asked. Okay, now, so that was the good news. Now we have the bad news, and I'm not going to beat y'all up on this, but I think it's important for us to know we still have work to do. In 2018, these are the missed opportunities, and I've explained this in previous years, that a missed opportunity, there could be extenuating circumstances. You all may know of some of these extenuating circumstances, but for it to be a missed opportunity to show up on this list, that simply means that a medical procedure was done that is also offered by a premier provider, but the premier provider didn't do the case. That tallies up a missed opportunity. It doesn't take into consideration that maybe somebody ends up in an ambulance going to the hospital to have emergency stent placement done. Can that be done by a KPP? Yes. Is it appropriate to redirect somebody? No, it's not. But so these missed opportunities are overstated. By how much? I don't really know, but I think it's still good information to have. 303 missed opportunities in 2018. About $875,000 worth of total missed savings. Average missed savings is $2,800. The largest single procedure that resulted in a missed opportunity was $41,730. And then we have the total missed opportunities since inception.
And I'll tell you, just so that you pass on to your employees, I think a lot of the missed opportunities come into play because you have an employee who goes to a doctor and the doctor says, I need an MRI of this. And the next thing they hear is a phone call from someone scheduling them for their MRI. And they go, oh, okay, 9 o'clock in the morning will be okay. And that's the point where they got to say, let me find out, tell me what it is that you need for me to do, and let me find out if I can get a better deal.
Can you write a prescription for that and let me call my
do an
benefits
order
provider?
for it so that I know what it is that they want. Otherwise, they'll schedule that person in at the facility that they direct.
Yeah. And I think a good comment to make on that is, that is, in the healthcare system, that is called the integrated care delivery model. And we've talked about that before as hospitals, as they continue to grow, they do tend to come in and buy up the independent physician clinics, and that's generally done for competitive reasons. And it's all about kind of, we call it's like widening the funnel. And the funnel leads to the hospital system. And we don't necessarily have a problem with that. I mean, I think that there probably is some merit to that in certain areas, but if they automatically will schedule you to use, say, a system-owned imaging center that maybe is across the hall, well, that's okay, but if you won't tell us what that imaging center across the hall charges before we buy it, and if we find out that they're charging $4,000 for something that should cost $500, well, now you kind of have a problem with the whole integrated care model. It starts to kind of look like a tool to overcharge. So that's why we have to exercise our consumerism and start asking questions. Okay, new KPP-free providers in 2018. We have several in Oklahoma. We have several in Texas. I'm not going to read all of these to you all, but I will highlight a couple. Right in the middle there in Oklahoma, for our Texas bankers, you pronounce that Tahlequah, Oklahoma. But that's it's a college town. You all, us Okies, know this, but that's a college town here in Oklahoma. Has a large health system for a rural college community in it, and this hospital, though, has become a premier provider. And so for folks that have said, well, the hospitals will never do this, they actually will. And I have 2 other hospitals around Oklahoma that have done this very thing as well, but they will only allow it to be basically their KPP offer will only be allowed, they'll only allow it to be extended to a local employer in the area, and they won't let me disclose it. So we're going to keep needling them, and we will eventually get them to step across the line into the light. But just so you all know, hospitals will do this. It's just a matter of time. The drumbeat is getting louder and louder. More employers are demanding this, and it is going to be coming to a hospital system near you eventually. The other one I wanted to highlight real quick is the one Surgery Center of Amarillo in Amarillo. For the Texans on the line here, if we have any from the Panhandle, you all know we've had a couple of webinars around this, and I really want to give a shout out to that Surgery Center of Amarillo. Amarillo is right there in the center of the Texas Panhandle, and you know, if you've got to be going to Amarillo, right? I mean, it's out there, and it is a regional healthcare destination. And there's a very, very strong, very, very dominant hospital system in that town. And we liken it, it's like buying gasoline on the turnpike. You know, they've kind of got you, and their pricing is very, very high. I want to give a shout out to Surgery Center of Amarillo, because those physicians, they all came from the hospital system to form this surgery center, because they were tired of seeing what the hospital was doing to the local businesses and to the patients as far as pricing goes. But it was a very, very bold move for them, because there will be retaliation against them, and it's crazy to think that that's kind of how this works, but this is big business, and those folks have been very, very brave. And so anyway, kudos to Surgery Center of Amarillo. Okay, kind of off of KPP Free. We have as you all know, we have 100% lab benefit. We've had it for years. The lab card benefit, if you utilize the services of lab card, which here in Oklahoma is DLO, Diagnostic Labs of Oklahoma, and Quest, and several of those others are all under that lab card. Also in one of a large independent lab that has an amazing reputation in Texas is Clinical Pathology Laboratories. They also operate in Oklahoma, but they're a much, much bigger deal in Texas. We were able to secure a direct agreement between Advanced Health Plans and CPL Labs. So that has now been added as a new 100% benefit. So you don't just have to use lab card to get outpatient labs paid at 100%. You can now also use Clinical Pathology Laboratories. The way that your members will access that is really they can just go to cplabs.com, find a location once they have their orders in their hand, and they go and they have their labs done at CPL Labs at a CPL Lab location. CPL Labs will mail that or electronically file that claim with the Kempton Company, and the plan will pay the lab at 100%, and your employee will have no out-of-pocket. Yeah, thank you so much, because actually, ma'am, let me get you the beatbox over here, because I know, sorry to throw a microphone in your face, but I do have a note here that says that the folks that are online can't hear anybody asking a question unless it's on the mic.
Okay, so does that include those who are on the HSA, or is it only for traditional members?
That is a great question, because I think Maria would have probably kicked me if I didn't bring that up. That is an awesome question. Any of the 100% benefits, they are limited by federal law. If you all are on a qualified high deductible health plan with an HSA component in that, the plan is not able to waive that deductible and essentially have 100% benefits. You must meet that deductible first. So maybe that'll change in the future, but right now that, with just a couple of exceptions, there are a few ACA mandated healthcare screenings and things that can be paid at 100%, but CPL Labs and KPP are not one of those. Okay, benefit changes. I'm going to try to go quickly through this, and Kempton staff members in the audience, please jump in if I misstate some of these things. Some of these are fairly nuanced, and these are really kind of cleanups. These benefit enhancements were all derived from hearing from our bankers. Were there benefits that were confusing, that maybe your employee felt like they got bait and switched? Of course, that was certainly never the objective. But at first, a good example is the all-inclusive office visit. Under the office visit copay, for all plans, you all probably will remember this, that anything that is billed by the doctor's office, that an in-network doctor's office, was paid under the copay, with the exception of surgical procedures. Okay? Now the rub comes in is when we define a surgical procedure, we use the AMA surgical, the code books that the American Medical Association uses. And there are sections that this is the surgical section. These codes are surgical codes. So we built the system that if it was a surgical code, it did not go under the office visit copay. The benefit was deductible and 80/20 or 70/30 if it was a surgery. The rub comes in is that there's a few surgical procedures that are coded as surgeries under the AMA, but are things that most real people don't think of as surgeries. One of those could be cleaning your ears out. An ear wash gets a surgical code. If you go in and you've got a sinus infection and you get a cortisone shot in the rear, that shot, it's got a surgical code. So the employees thought, well, this should be all under my copay, and then they end up getting a bill because it went to their deductible. So what we've done, effective January of 2019, is that minor surgical procedures will now be picked up under the office visit copay. So what's a minor surgical procedure? We're still working on defining that perfectly. Where we're kind of, if it is a high cost medical procedure, for instance, one of the things that we had thought about is sometimes people will get a steroidal injection into a joint, into your knee joint to help your joint function better. Those are usually done under local anesthetic. That is surgical, it is high cost, and it requires anesthetic. That's going to still go towards your deductible and coinsurance. But some of these more minor surgeries that are low cost, don't require any type of anesthetic, are going to be picked up under the office visit copay. So hopefully that will calm some folks down, and they'll have a more pleasant feeling about how the plan. I think people sometimes think we're just picking on them or something like that, and the call would usually go, well, I mean, I'll be walking through the hallway and I'll hear one of our reps say, yes, ma'am, that is a surgery. And I know what the banker is saying on the other line. That's not a surgery. But that's how it was coded. So anyway, that's the first one. Second one, the benefit for physical therapy, manipulative therapy, and chiropractic visits, those were based upon a copay, or if you were on a health savings account, you had to meet your deductible first, but copay, and then the plan would pay 100% up to $75. That $75 limit is now increasing to $95. But that's the good news, but the really good news is the second section, which is physical therapy after surgery. In 2019, physical therapy post-surgery is also going to be paid like the copay-based physical therapy. So pay your copay as long as the physical therapy is less than $95, the payout is less than $95, it'll be paid at 100% after the patient submits their copay. Okay? What did it used to be? If it was a post-surgical physical therapy, it was held to your deductible and coinsurance. The thought process there is, back in the day, was when if you had surgery, a big surgery, you would have met your deductible and you would have met your coinsurance, and so this physical therapy would be paid at 100% anyway. But guess what happened to us? KPP happened to us. And so we had people getting surgeries, not meeting a dime of their deductible or their co-insurance. And next thing you know, when they had post-operative physical therapy, if the physical therapy was not part of the bundle through the KPP, they had to meet their deductible and co-insurance, and it was a downer. Participants didn't like that. So hopefully this will clean that up, make it a little bit more consistent and more logical. CPAP replacement supplies. These CPAP machines are for folks that have obstructive sleep apnea. If you have a CPAP machine, then the replacement supplies were generally never covered before. In January, they will be covered in 2 situations. First off is if you use a specific KPP for that. Right now, we only have 1 in the category. And we can, when you call, we can give you the name of that particular premier provider. So if you use them, then your replacement supplies are now picked up at 100% with really no limit. It's basically whatever the doc thinks you need. Or expenses related to the replacement CPAP supplies may be done may be paid for if you don't use a KPP, but it will require that provider to provide the plan proof of patient compliance. And the classic concept here is somebody gets diagnosed with sleep apnea, they get a CPAP machine, it is ill-fitting, it's uncomfortable, your spouse can't stand it, whatever, it ends up in the closet or ends up under the bed, it's never being used. And a lot of times some sleep physicians have kind of sweetheart deals with durable medical equipment suppliers for the masks. And if you have benefits for replacement masks, you will get a mask every 6 months on your doorstep. Every 6 months. That assumes that your insurance pays for it. If your insurance doesn't pay for it, that doesn't happen. But if you're not wearing it anyway, and it's in the closet, so you have a CPAP machine that's not being used, plus you have 16 boxes of new masks and hoses that the plan is paid for, and the plan has gotten, nor the participant has gotten any benefit from that at all. So what we're trying to do is, if we can use a medical provider that is going to be able to document that you're using your machine on a regular basis as prescribed, then the plan is getting value for that investment, and you're basically under the doctor's care. Some technology has occurred, some technology advancements have occurred that really enabled this benefit to be able to work that way, and it's really the reason we can do it today, and we didn't ever want to do it before. And that technology is, there are certain CPAP machines, and raise your hand if you've got one, that actually have a cellular modem built into the machine, where the physician, generally the one here in Oklahoma and we're looking for others, but the one physician here in Oklahoma, they dial in to that machine on a weekly basis, make sure that you're wearing it, and then they also are able to remotely adjust your pressure and volume. Basically, they are caring for you remotely on a continual basis. That is a high-value medical provider, and we want to make sure that you have those supplies and everything under that type of an environment at no cost as an incentive to remain compliant. Does that make sense? Does that sound logical? So it is a benefit enhancement with a few strings attached. Yes, ma'am. Better get the beatbox. Hold on, ma'am.
Does a DME supplier have to be licensed, or can it be purchased through a doctor's office?
That is a great question that I'm actually going to address here in a little bit. We don't care where you buy it. We just want to make sure that we're getting a decent deal on it. In fact, actually you're kind of stealing some of my thunder from a future slide, but yeah, DME is something that again, if we want to buy a doctor prescribed piece of medical equipment off of Amazon and send in a receipt, the plan will reimburse you. Darn right, because A, we know that we're getting a good deal on it generally. It's a market-based price. And what we see from Amazon versus what we see from many DME suppliers is the DME suppliers have multiple hundreds of % markup for the exact same device. Okay, a couple more benefit enhancements. Hearing loss services and devices. Hearing loss was something that was never covered under this plan, never has been covered. So what is changing is we're essentially going to be treating the ear and hearing like any other part of the body from an illness and injury standpoint. However, this is the big but here on this is, as it says they're not covered if due to sensorineural hearing loss. Really, that's a fancy word for saying if you're just getting a little up in your years and you're losing your hearing, that's sensorineural hearing loss. If you have gone hunting too much or you've gone to too many rock concerts, sensorineural hearing loss, and the plan's not covering that. But if you end up with some sort of a medical condition, there's a whole slew of different injuries and illnesses that can occur that can rob somebody or impair their hearing. We will be able to provide benefits for hearing devices for that. It's limited to $2,500 for each year, one device per ear per lifetime for that. If we're talking about a kiddo, somebody that is under 18, then those limitations may be able to be waived based on a medical necessity review. It's probably a lot of the ladies in the room that are moms know that, you know, if a kiddo doesn't hear good when they're young, it can impair all sorts of things at future life. So the plan does want to be a little bit more generous for folks that are under 18, but that's going to be a facts and circumstances determination. This next one, Maria just shook her head when we were trying to work through this, but this is another one of those kind of cleanup concepts here. For those of y'all that have been on the trust for a long, long time, it seems kind of crazy, but prior to the Affordable Care Act, you know, the Affordable Care Act, Obamacare, whatever you want to call it, is they were very high on preventative medicine. We want to really have a lot of screenings, and if we can maintain your health, then it'll cost less in the future. If you all will remember, Advanced Health Plan's benefits related to preventative care were actually more rich before the Affordable Care Act came around. The Affordable Care Act, for instance, limited, for mammograms and colonoscopies and things like that, there were age limits and frequency limits and everything else that were more stringent or more restrictive than Advantage. We are raising the white flag and we're just saying, we're going to comply with the ACA, but we're also going to enhance those benefits back to a pre-ACA benefit level. And really what that means is we don't care anymore how old you are or anything if you're a 26-year-old female that wants to get a mammogram, get a mammogram. Even though that's prior to the Affordable Care Act's limitations, we don't think you're going to get it unless you feel like you need it. If you get it and you're earlier than the ACA mandates, you will have to meet your deductible and your co-insurance, unless you use a KPP. If you use a KPP, it'll be paid at 100%. But if you have these screenings, examples are colonoscopy, bone density scan, screening, mammogram, if those are done within the ACA guidelines, so you wait until you're of the age that the ACA mandates that you get those done or mandates the benefits, then they will be paid under the ACA mandates, which is 100% with no cost share at all. Does that make sense to everybody?
Where can we find that? Where are the ages, the ACA ages?
Your account rep will get those to you. All I know is yeah, Megan, you want to give, Teresa, can you repeat that?
I was asking what the ages are through ACA.
Yeah, why don't we send a did you know out, Megan, on that, just to refresh everybody for all of the screenings. Bottom line is that this benefit is no longer, we're now in 2019, we will have benefits for those routine screenings as long as they're doctor prescribed, paid at deductible and co-insurance unless you use a KPP, and then they'll be paid at 100%. Okay, and this is really not a benefit enhancement, the next slide. It's just this is the way these plans have been structured. I think we have a few banks that are on one of the minimum value plans, the MVP plans. That's not most valuable plan, minimum value plan. Those are really the get out of jail free plans that if you needed to be able to offer the lowest cost plan possible that would check the ACA compliance box. Those MVPs provided that. The out-of-pocket maximums for those plans, if you all will recall, those are indexed to the federal maximum out-of-pocket limits, and those do go up every year, federally mandated. And so since the plans out-of-pockets are tied to the federal mandate, those are now going up to the $7,900 for single coverage and $15,800 for family. They took a big jump this year from the feds. They follow the ACA maximums, and remember, those plans don't have deductibles. So once you meet those essentially deductibles, it also meets your the out-of-pocket max and the deductible are the same thing on those plans. Okay? Okay, now the next section is protecting your plan. This is where I think most of our employees probably have the biggest struggle. And it has to do with, if you're here at the user group meeting, I see a lot of familiar faces. You all are the folks that are very, very plugged in. We try to try to work together as a team to make sure that all of our employees and dependents are plugged in. But really from here, this section is really based upon feedback that we've gotten from our member banks. Under ERISA, being that this is a self-funded plan and the trust assets have to be used in a prudent manner to provide benefits to qualified beneficiaries, the plan can't pay $1 million for a Band-Aid, right? Because paying $1 million for a Band-Aid, that's not a prudent use of plan assets. Now, we don't have any $1 million Band-Aid claims, but we do have a series of medical procedures and components within medical procedures that they're getting close to $1 million Band-Aid in equivalency. And those are the things that we're going to talk about here. How do you protect yourself and your plan from price gouging? How to talk to your physician. Next slide, Megan. So how, if we all here in this room, if we have a responsibility to make sure that these trust assets are always used in a prudent fashion, that we can only reimburse things at a reasonable payment, well, how do we determine reasonableness? We all run under kind of this prudent man, prudent woman standard when we're looking at the expenditure of plan assets. How do you determine those things? Well, in healthcare, it's hard. It's very, very difficult, especially with the biggest smokescreen that was ever invented, the PPO network, because we've all been trained that as long as we're getting a discount, it must be a good deal. It must be a prudent price. It's not. You all have heard me yammer on for years about that. So if we can't believe the amount after a discount was applied as being prudent because the starting point was so high, 50% off of a egregious price is probably still an egregious price. So what other methods can a plan use to determine what is a reasonable payment? Well, there's several. And I was using the example before this started, actually with one of our technicians in the back talking about reference pricing. I say, I don't want our bankers to think about reference pricing as, the dreaded Medicare Plus and things like that, because we use reference pricing in everyday life. If somebody bought a cup of coffee this morning and they went to the store to buy a cup of coffee, you determined whether or not you were going to buy that cup of coffee at the price the coffee shop wanted to sell it to you based on a reference price. The reference price just happened to be in your head. And the reference price was based on, what have I paid for a cup of coffee before? In other words, if I've been paying a couple of bucks for, or $5 for a cup of Starbucks coffee, and then all of a sudden I go to a coffee shop and they're charging me $38 for a cup, well, that's outside of my reference price that I've got in my head. It's outside of what I've experienced in the past. So Advantage is looking for a reference price. A reference price can be a lot of things. One of them can be Medicare. What does the federal government pay for that bit of medical care to a doctor or to a hospital? It's not a free market price, it's not a market clearing price, but it is a reference. If you're in the medical community, if you're in the medical business, if you cannot survive on what the government pays you in Medicare, you will go out of business. Because there's so many participants that are under Medicare or some sort of government plan now. Medical providers have, trust me, I know enough of them, talked to enough of them, they are trying to get their cost in line to a point where they are profitable at Medicare. So Medicare kind of becomes a decent reference. Another reference could be the free market price, a KPP. I mean, KPPs, they don't just offer that pricing to Advantage Health Plans, they'll offer it to somebody working here at the hotel or your cousin in Des Moines. I mean, it's the price that they like to do business with any cash buyer. So a KPP price is a market price. As the question about durable medical equipment earlier, the online price, Amazon.com or any other price in the retail sphere, that's a great reference as well. And there are things that we buy through the medical industry that are available from other sources, like Amazon. HCBB, a Healthcare Bluebook. What's the Healthcare Bluebook fair price? Healthcare Bluebook fair price is determined based on their database of several 100 million claims, millions of participants, and they look at cost information about where are medical providers profitable at different levels, and that ends up becoming the Healthcare Bluebook fair price. So those are all references. Make sense so far? Okay, so here are a few of the, next slide, here's a few of the benefit limitations within Advantage Health Plans where we have seen really egregious abuse, where we see what's being charged is way, way, way out of line with what a fair reference might be. First off would be out of network. And as you all know, when a participant, well, one of our employees, if we go to an out-of-network medical provider, sometimes out-of-network providers charge a very fair price. We have a lot of them. Surgery Center of Oklahoma is a great example. They're out-of-network with everybody. They don't do business with insurance anymore. They are the ultimate free market surgery center. They're out-of-network, but they're already reasonably priced. But other out-of-network providers, if they charge an egregious amount, the plan is going to limit what it pays out to that out-of-network provider. What are we going to limit it to? For physician charges that are out-of-network, we're going to limit it to whatever that physician gets paid by Medicare, plus an additional 20% above. If it's a hospital or facility and it's out-of-network, it'll be paid at whatever that hospital gets paid by Medicare for that medical procedure, plus an additional 50% above. If it's an emergency type of situation, then it is whatever Medicare would pay for that emergency, plus an additional 100%. So 200% of the Medicare price is the maximum allowable under the plan. Now, just between us chickens, remember I told you all the secret that there is an additional negotiation window that the trustees have authorized. And that additional negotiation window is there to hopefully be able to negotiate with the medical provider any type of balance billing that might occur. So the plan, let's say it's a doctor's office, it's out of network, the plan pays that doc what they get paid by Medicare plus an additional 20%. The doc says, that's not enough, I'm going to send a bill to the patient. Well, we have an additional 30% that we can go up, so from 120% of Medicare to 150% of Medicare, if the physician will sign a document that says that they will accept this as payment in full and not balance bill the patient. Okay? Now those numbers are things that your board could change to increase or decrease. And those are things that we're trying to gather feedback on. Are these numbers too low? Are these numbers too high? And those are all, but Maria is paid by your trust to always try to help your board determine. We just can't pay whatever the medical provider, whatever the medical community chooses to bill if it is unreasonable, if it is egregious. Okay? Any questions on the out-of-network? I'm going to start stepping through these. The next one is implantable medical devices, and I've got a couple of great examples that have hit the news very recently on that. Not through us either. Implantable medical devices. Those are going to be things that are designed to stay inside the human body post-surgery. So it could be a rod, a screw, some mesh, a pacemaker, a heart stent, an artificial knee joint, anything that's going to stay in your body. These are widgets. These are things that are tangible. Trying to determine what a surgeon's time is worth is a little bit more difficult because, hey, it's art, right? It's hard to put a price tag on what a surgeon's time is worth. But when it comes to a widget, a rod or a screw, there's very likely to be a suggested retail price for these things, and there is. Because the hospitals, the physicians, the surgery centers, they all buy these implantable devices from a supplier. Just like in your bank, you buy copier paper or paper clips. And so the plan will limit what the plan will pay for an implantable medical device to whatever that medical provider paid for the implant. So we will request a purchase invoice showing what they paid for it. And then the maximum plan payment will be whatever they paid for it plus an additional 100%. We're going to double their money. We're going to give them 100% profit on that rod, on that screw. That's pretty generous. I don't know a lot of other businesses that can be guaranteed 100% profit, but you got to remember they're already getting paid for the expertise that it takes to implant this thing. So the surgeon's already getting paid for it. This is just for the widget. Sometimes medical providers, they will not cough up the implant invoice. We do have some that will not. In a few years ago, if we didn't get the implant invoice, the plan just couldn't issue a payment. Probably much to the chagrin of some of these bad actors out there. We've got a pretty good database of implant invoices these times. I mean, plus, our KPPs do a lot of implants. And our KPPs actually when they send Kempton an invoice for a KPP procedure, if it's got an implant involved in it, they send us the purchase order. And we just pay their cost with zero markup. And so I got a lot of folks on my contact list that if we get a claim in on an implant and the hospital won't give us any information, purchase order or anything else, there's a lot of folks that we can call, the good people out in the medical community, that they will tell us, oh, that's a Medtronic 6790. I'll tell you exactly what we pay for it. And so if we're able to get it, we'll go ahead and allow that price plus 100% and pay the provider. And sometimes they'll squawk a little bit that, well, you don't know what we paid for it. Well, we don't know because you never told us. But to get this thing off high center and get our participant, our banker taken care of, we're going to approximate what we think you paid for it plus 100% and get that money out the door. If you're not happy with it, if you think we underpaid you or overpaid you, tell us what you paid for it and we'll correct the claim.
It is shocking, but this is probably one of those areas where the biggest padding occurs. It's like the $10 aspirin or the $50 Pampers box that just never should happen. these implants are horrific in what their markups are. And I mean, they're so horrific, I think most people, unless you've seen invoices for them or have had one, you would just not believe how egregious they really are.
And I haven't seen a PPO agreement yet that doesn't allow the medical provider a carve out on implants. Even if it's a network agreement that's got really great discounts, let's say it's 60% off billed charges. Still, we don't know whether we're getting a good deal if billed charges are not reasonable. But in almost every network contract that we look at, even with some of the big insurance companies, implants are carved out of the agreement. Say it's 60% off of billed charges for all of this, but implants are going to be paid at 5% off billed. And if billed has been marked up 1,000%, we're getting taken advantage of. Okay, so moving on from that, I've got some great examples, Maria. I don't think you've seen them yet on the implants. Interoperative nerve monitoring. This is every KPP that we have. If the medical procedure requires interoperative nerve monitoring, and that simply means that let's say you're having a spinal procedure done, and they're actually working on your spine, you will get wired up as a patient in the OR, and there will be telemetry that goes off generally to an off-site neurologist that is sitting there looking at a screen and then telling the surgeon, yeah, well, you're cutting a little closer there. I don't know what they're saying to them, but they're giving the surgeon feedback. That's my junior doctor's impression there. But they are giving the surgeon feedback. The KPPs generally build in about $1,500 for interoperative nerve monitoring in their operating rooms. And these are vendors that they hire, but they just say, hey, we're not going to pay you more than $1,500 for this because we know what you do. A lot of surgeons will say, I don't even need that. I've been doing this long enough. I don't need it. It's kind of become the rage, though. The plan does limit interoperative nerve monitor to $4,000 flat. We have seen bills for interoperative nerve monitoring over $100,000.
Whoops. It's a typo.
Yeah, one of them said, oops, that was a typo. But anyway, we have generally gotten those negotiated down very, very quickly. But if they think that they've got a live one, they think they have a gullible patient that demands that their insurance pay that, boy, they will sink their claws in and they become much, much more difficult to negotiate with. It's the craziest thing. So we do limit that to $4,000. That price should never, I'll tell you where I got the $4,000 from. One of my clients, non-bank clients, happens to be a neurology group. They do this. And on their own plan, they put that $4,000 limit in their own plan and said, we're not playing that game. And so we said, well, if it's good enough for a neurology group for their own self-funded health plan, it'll be good enough for our bankers. So anyway, watch for that. Air ambulance, it is indexed to Medicare plus 20%. Dialysis, this has probably been our home run of all of the reference-based limitations. Dialysis, for smaller benefit plans, ones that are 300, 500 employees and less, dialysis can kill a plan. They really can. These can be million-dollar claims over multiple years, especially if you're relying on the PPO to control the cost. Advantage now for about 10 years has limited outpatient dialysis payments to whatever that medical provider gets paid by Medicare plus 140%. So 240% of Medicare is the limit. And you're thinking to yourself, most people with outpatient dialysis are probably on Medicare. So if these places are making money, they've got to be making money at Medicare. Why are we paying them 240% of Medicare? Well, generally what they bill to group health plans is Medicare plus 1,000%. But don't worry, if you have a PPO, they can usually get you a 50% discount where you're only paying Medicare plus 500. Again, we've never had a balanced billing situation at Medicare Plus 140. But these are the things that are within advanced health plans that do have a limit or some sort of a protection because the PPOs do such a poor job of controlling these costs. Next slide. A couple of quick examples. This one you actually have in your packet. This was a news article that came out actually from St. David's Hospital, which would be for in Texas. It's one of the top great big hospital systems, got a very good reputation, be kind of like Integris here in Oklahoma. This has nothing to do with advanced health plans. This is one that's in the news. Total billed charges for a cardiac stent placement, billed charges were $164,000. This person's insurance plan paid $55,000. The patient was balance billed $108,000. Just for reference, we do have a couple of KPPs that provide this exact same procedure. The all-in, all-done cash price for this exact same procedure is $18,000, including the stents. They came after the patient, though, for $108,000. For reference, the Healthcare Bluebook fair price was $36,000. Well Rhythms is like Healthcare Bluebook. Their fair price was $26,000. Again, the KPP price is $18,000. But next slide, this is where the action was. This is why there was such a large balance bill with this insurance company. First off, the stents, the median invoice price for these types of stents for this particular patient, what the hospital probably paid for them, was about $4,600. What they billed for them was $42,000. So not just Advantage Health Plans, but another insurance plan is limiting what the markup can be on those implants. This is a mugging. I mean, this is a holdup. I mean, it really is. The patient had no ability to shop ahead of time. They had no ability to really discern whether this is a good deal or a bad deal. And unfortunately, in this case, when you have an ignorant buyer, the seller is going to try to take advantage, and they did in this case. Next slide. This is actually an AHP participant. I'm not just belaboring, I'm going to come to a punchline here in a minute. But this is an actual banker, an AHP participant. This patient had a cervical disc replacement in her spine. Used an in-network hospital. The total bill on that was $132,000. The implant charges alone within that bill were $89,770. Your plan requested an implant invoice. We never got one, but we were able to get the price for these particular implants because we were able to get an operative report, which gives the make, model, and model number of the implant. I mean, it's like we're buying a pair of shock absorbers. It's interesting like that, but there are part numbers for these things. And we were able to call a friendly provider and get the price. The price was around $9,000 for that surgical implant. The plan marked that up or allowed 100% profit on it. We paid $18,885 for that. The hospital, which I'm not going to give you any details, this is a real participant. The hospital came after the banker for $70,915. As they said that what your bad insurance paid was not adequate. It was not our, I love this term, it was not our expected payment. This participant did everything right. And that, I think, is the punchline here. Did almost everything right. They called the administrator, they called Kempton. We made the participant aware of the implant limitation because we did know that, yeah, there was going to be a surgical implant in this. Told me, this is going to be held to whatever the cost is plus 100%. We also told them that there are numerous KPPs very reputable, high-quality facilities that do this procedure. It was the same story we've heard. We hear it every day. Well, I really like my doctor. I'm comfortable with the, the location, et cetera, et cetera. But this was the part that once I got involved in this, when it hit the fan, as you can imagine, with a $70,000 balance bill, that's gonna leave a mark. When I got involved in this, the patient said, well, I heard all of this information that the Kempton Company gave to me, and I understood that I could use a KPP, and I understood that the implant would be limited, but I had no idea that my hospital would do this to me. When they told me that we would be doubling the hospital's profit, we would pay the rest of the bill like, just regular, pay off very quickly and pay the rest of the bill. When we started talking about the implant, it never crossed my mind that a cost plus 100% profit would not have been adequate for my hospital. And so the punchline, next slide. Believe it. When, again, this is a partnership type of a deal here, is most of us don't believe that this kind of stuff that can happen to us, but it can. And so how does a participant protect themselves from something? First off, if it's voluntary and elective where you've got a little bit of lead time, have a conversation with a Kempton Care Advocate. Talk to your rep, talk to Todd, talk to Melissa about this. Have the conversation with your medical provider. Remember those cash price agreements? Remember we talked about those earlier, where if it's a procedure that can be done by KPP, we can provide you with the all-in, all-done price. So your employee may not know enough to talk about the surgical implant cost that's going to be in their spine after the surgery, but they would be armed with, hey, doc, there's 5 facilities that will do this procedure inclusive of everything for $40,000 to $55,000. What are you going to charge? What is the out-the-door price for this from the hospital? What is this whole bill going to, I don't need it to the penny, but give me a range. Can you give me a range? And if the hospital either won't give it to your employee, won't even have the discussion, that should be a yield sign at the least, right? So really that's what we're asking to start that dialogue with the medical provider. If this participant had taken the information that we had already given them, taken it to their hospital, had that conversation, that surprise might not have happened. I can tell you the end of that story is that banker was not bankrupted. The plan was able to negotiate with Maria's assistance, lawyer to lawyer. We're able to negotiate something down to if we squint one eye really hard, it was kind of reasonable, and we were able to take care of that for this banker. But we can't do it every time because, again, but for this particular situation, it would have financially ruined this person. I would put a dent, they would have been in the ditch. And that is not the intention of your board or any of you, well, I know that. But we've got to be armed on this. We've got to do a better job of communicating what can happen to our participants. Any questions or comments about that before we move on? I think that's kind of the end of that conversation. You want to grab the box? I'm sorry.
What's unfortunate about that is then they're mad at the insurance company when it's not the insurance company's fault.
Right.
That's what's so unfortunate about this. It's very hard to get that discussion. All they know is they won't, they aren't paying.
Right.
Instead of that they didn't do their due diligence and there's another way. That's what's unfortunate.
That's absolutely right. And the other story is, and this is difficult to talk like this, but again, it's because the hospitals, they will say, well, your insurance won't pay. And this is actually one of our things is, I don't have insurance, folks. This is not an insurance plan. My bank is self-insured with other community banks, and we're just simply looking to pay the hospital a fair and reasonable reimbursement, and we think that you're taking advantage of us. I mean, that would be the conversation that I would have with my physician. And you know, you're not going to be able to go talk to the CEO of the hospital, but start with the surgeon. We spend a lot of time with surgeons and physicians, and it's starting to bubble up where when you start having these conversations with surgeons, Surgery Center of Amarillo, we talked about that. Those folks were saying, I took an oath as a physician to do no harm, right? It's a Hippocratic oath. Doing no harm to them physically, but contributing to their financial ruin, some physicians are starting to really hit them, where they're saying, physicians don't set these prices, folks. It's the hospital systems, and so many of them now are, and I'm not like a socialist here or anything, I'm a red blood capitalist, but I want everybody to make money. But a lot of these health systems, they're traded on Wall Street. And I mean, they're looking for showing shareholder return next quarter. And it does kind of conflict with a physician, an ethical physician, where they're starting to say, I'm almost like accomplice to a mugging here, because I know that this is not fair, and I'm the one that recommended, I'm the one that did the work. So anyway, communication's key. Let's have those conversations. We will assist your patients with being able to, what do I say to my doctor? What are my options? That's what we're here for. Okay.
There's some self-funded hospitals. Stillwater Hospital does 130% of Medicare for physicians and 150% for the hospital.
Yes. I have a few medical groups that are clients of ours. And the medical groups, they are the most penny pinching. They're doing everything Advantage Health Plan's doing plus more to watch their own dollars. When their own employees go to another hospital, they will pick up the phone and say, you're not doing this to my employee, because we know what this stuff really costs. And so they can have a conversation that unfortunately a banker can't have until we're continuing our educational process. But that's a great point that you make, that the medical community, there's a whole nother economy that goes on medical community to medical community. And it's a different set of pricing than what we see.
You know, at your individual banking locations, I think it'd be an interesting conversation to have with the employees to say, what if you went into the local coffee shop and the cup of coffee, the price that you get depends on where you work or what your position is where you work. So if you're the CEO, your cup of coffee is $20. If you're the college student, yours is 10 cents. But you're both getting a cup of coffee. And they'd look at you like, nah, they don't do that. And you go, yeah, they do. They do it in healthcare, because that is what's happening. It depends on who your insurer is as to what they're going to charge you. And I personally, I would always go, so you mean to tell me that you're going to do something different if I'm covered by Blue Cross than if I'm covered by Aetna?
I thought that's illegal. All those contracts say you have to charge the same as you do to somebody else.
You have to charge the same, but the discount can be different. That's how they get around that.
The master charge list is the master charge list, but the discount that they give them is different.
But the story, to dovetail on what Maria was saying, the story that we tell the medical community is we're not insurance. We don't care. It's not what insurance do you have. We're trying to get the medical community to see us as American Heritage Bank, right. First National Bank of somewhere. You're dealing with us. We're patients. We're real people. We're not insurance. We're not an insurance company. We're not a logo. We are Exchange Bank and SkyTook. We are Advantage Health Plans. We are our own plan. We're not insurance. We're paying this right out of our general assets that have been contributed to the trust. And that is resonating with a lot of the medical community. Not all, But as you can see, the number of KPPs expanding. That's the conversation that's different, is that we are not in the commercial insurance business, never have been. And that's really probably the biggest change that your board has made, is we're out. We don't play the insurance game anymore. This is about buying and selling. We're buyers, we're educated, we're getting more educated, and we're looking for sellers that respect that. So, Maria?
Don't be afraid to tell the doctor they don't understand.
Yeah.
Say, let me educate you. But let me educate you quickly on the legislative update. If you can remember back the last 6, 7 years, we've kind of seen the ACA, PPA, Obamacare, PAPACA, the bad names I called it, and all those other things, kind of start off slow, and then it revved up, and they added one piece, and then they added another piece, and then they added another piece, and then they delayed, and so we saw it kind of go up. You're watching the downhill slide now, and it's coming down in pieces. The individual mandate is gone. And that's a good thing, really. It's being used as a scare tactic for a lot of individuals, because they say that now that they can buy insurance, and they're talking not group insurance, but individual market insurance, that they will be able to buy products that don't provide them all of the ACA requirements. Well, if I'm 65 years old, I really don't need pregnancy coverage. Why would I want to buy that? It isn't for me, it's for somebody else. So, I don't think that it's necessarily on the downhill in terms of what the employees or the individuals per se are going to feel. I think pre-existing conditions are here. They're
gone.
That's not going to change. That's there. It was the individual market that the Obamacare plan really promoted that in, because they've been gone in group health plans for much, much longer. So some of those things just aren't going to go away. They're going to stay. But they don't have the requirement that they have to go buy health insurance. For the young that don't think they're ever going to get sick, they may not want to have insurance, or they may want only catastrophic insurance, which is, kind of like your fire protection in your house. And that may be all they need. So it's not a bad thing. I was reading today before I came out here, there are a couple of bills in the House that are trying to do with the employer mandate. I would love that personally. I think that the time has come for them to do away with that. They are kind of hitting Obamacare a little bit at a time in bits and pieces. And as they do that, I think you're going to see more and more of the legislation come undone. They can't undo it all at once, like, just rescind the whole thing, but they are doing it. So it's happening. And I think over the next few years, we're going to talk about, okay, that piece was gone in 2017, that piece is gone 2018, this piece is coming down 2020. The Cadillac tax, which was supposed to be in play, they're looking to defer it to 2023. Why they just don't let it die
How many
is
times has
beyond
that
me.
been
Every year it gets
punted?
extended. And the only reason that they extend it instead of killing it is because they play a monkey game with numbers, and it's a revenue number in the year that it, quote, comes back. That's a gimmick. It will not happen. The tanning taxes, those things, they're trying to do away with them. So I think we're slowly
Tanning
watching. Tanning beds.
Yes. I was like, tanning? What are you talking about?
You pay a tax on it.
Yeah.
You think the guy doesn't pass that tax on to you when you go tan? But they're coming undone.
Not sure.
So do you have to fill those 1095 forms out then again? You don't, right? It's over with?
We did, I think that's still on. That's the employer mandate.
Gary is nodding his head in the back, and he is the man that knows.
It's on for 2018.
For 2018, it's, from my understanding, we still have to file the forms for 2018. For 2019, there's no individual mandate, it's repealed, so I don't see a reason to file it, but they have not said we don't have to file it.
Yeah, there's separate provisions of the Internal Revenue Code that kick in. The bill I saw today was trying to undo the employer mandate, which is part of the reporting obligation on the employers. And that's where they pay the taxes if they don't offer coverage to everybody. They're also looking to change that magic 30-hour number. Guess to what? 40. Lo and behold. The Trump administration is kind of chomping away at it. Some people are saying that it's through executive action. Some people are saying it's through not following through on the regulations. I think it's coming from all ends. I think you're seeing little bits of it coming through Congress. I think you're seeing some of it coming from the agencies, and I think you're seeing the direction coming from the White House. Association health plans is one of those things that came out of the executive branch and was implemented by the Department of Labor. And for the life of me, I'm still looking at this going, are you nuts or what? It looks to me like it's a piece of the co-ops that were part of Obamacare originally, all of which went bankrupt, or maybe one still alive. The rest of them went bankrupt after taking a lot of federal money. There's not a whole lot in it that is going to benefit us. I've talked to the Oklahoma representatives at the insurance department, and they look at association health plans as MEWAs. And, you know, like Oklahoma is not a state that likes MEWAs.
Nor does Texas.
Texas doesn't necessarily like MEWAs. But they're treating them like MEWAs. The only thing is they're putting on some handcuffs on them that are just a little bit too much to work with. And that is that you define the category of employers and then you are required to accept them. So if you defined your category as community bankers, then it would be any community bank, whether or not they're a good risk. You don't get to look at the risk of the employer. They're just a member of the family, so come on in. That's not a good thing. I don't see Advantage ever moving out of where it is and transferring into an association health plan. One, we're not an association health plan. We're really employer-based, and we're not formed by an association per se. They've set up the DOL reg to redefine employer and permit associations to come into play to form these things. That's a very treacherous, slippery hill that they're climbing. They're looking to do something similar in the retirement plan arena. There are better choices than what they're doing on that. But I just don't see, I don't see any of these things coming to play. I know in Oklahoma, the insurance department was talking to insurance companies about setting them up, and I think they would probably have the same kind of reaction to it. If I've got to take everybody without any kind of underwriting, you're missing the boat. You know, you completely missed the boat.
Yep.
There will be other changes coming. I think it's an unraveling of changes, but fortunately, no new benefits. I personally would like to see all of this preventive stuff go away.
As a mandate.
From a mandate. Not to say that the plan won't provide preventive benefits. but the scope of some of these screening things that are built into it that just make no sense to me. Some of that stuff needs to go away. But fortunately for us, there's not that much I can tell you this year. That's it. That's about the shortest I've ever done.
That's pretty good, Maria. We appreciate that. I told you all this was going to be a good news conversation. So, one more slide. One more slide, man. We're right at the end, folks. I think we're going to get done on time and everything this year, so it's right on. Practice makes perfect. Are we enjoying the new member portal? Do we know about the new member portal? Okay. We have been getting some very good reviews back from the employers in regards to the member portal. The next phase of that is about ready to roll out, or it will be ready to roll out for open enrollment season for Advantage Health Plans. So really the moral here is you all have a decision to make. And well, you don't have to make one, but if you don't make a decision, we're going to make it for you. And really the new web portal and online enrollment system for Advantage Health Plans is it's going to be kind of done on an opt-out basis. So if you do nothing, we're going to enroll you in it. And so doing your adds, deletes, changes, enrollments, etc., will be done through the portal. Which I think will be a great thing. I mean, I think that'll be a wonderful enhancement. You don't have to do it though. If you want to keep doing what you've always done, which is, you know, mail, fax, email to Cindy, whatever, you can certainly continue to do that, but you will have to opt out. So you'll need to send us an email that you would like to opt out of the online portal. Also, your monthly billings will be, if you choose to opt in, your monthly billing statements will be on the portal, where it will be kind of your own personal filing cabinet out there on the portal where you can always go back and refer to those. The other nice thing about it is the online portal is it's of no cost to the individual member banks. The trust is going to be absorbing part of that cost. Kempton is also going to be it's a share between Kempton and Advantage Health Plans for those portals, but the moral of the story is no participating member of Advantage Health Plans will be paying for that portal. So anyway, any questions or anything? We've got some of the folks here in the office, or here from the office, that work with that very intimately. So any questions or comments about the opt-in, opt-out? Yes?
How would you do your life insurance on dependents? You know? How would you do the life insurance for
Gary,
dependents?
you wanna
Who's the
address that?
beneficiary?
We are working on that. The goal is to have any voluntary products where they can also enroll in those items for the beneficiary determination letters. Some companies require a wet signature, or basically an original signature. We actually we're supposed to have a demo this week, but it got canceled. That company is rolling out their own portal, and if we can link our portal to their portal, there will just be a seamless link, and they can sign in, select their coverage, put in their beneficiary. They will accept that as an original signature. We would get that file back to us, and everything would be good.
It'd be similar to like DocuSign, I think.
Yeah, right now we haven't seen it yet, so we're still working with them to see if it's going to work out as intended. Worst case, you can still enroll online, send in the form with the original signature. We'll keep it on file and forward it on to them.
Our goal is to have the full enrollment and eligibility obviously for Advantage Health Plans, and then as many of the voluntary benefits as we can possibly technologically accommodate would be on that portal. Okay, all in one place.
Did you say when?
Gary?
Open enrollment.
The question was when?
When? Open enrollment.
And when is open enrollment?
October 15th is the goal.
Yeah.
You know, when you have an increase in the ages on the extra coverage and optional coverage. As the employer, you don't realize it's happening until you get an invoice, and you better look
Right.
it over every month.
Right.
So you don't notify them, there's no way to give them a heads up, say, this person's, it's gonna go up like $25, because that did happen to somebody, I think they turned 50 or something, I don't
Yeah,
know.
those are things that we actually don't track within our claim system because it just doesn't accommodate. I mean, it's a claims adjudication platform. I don't know whether or not the carriers could send out a notification. Summer, do you?
They never do. They don't until you
Yeah.
get the bill, but a lot of plans we set up that it only does it at plan anniversary.
Okay,
Instead of having it track throughout the year when an actual participant changes the age class, have it only happen when the anniversary.
oh, I didn't know you could do that. You could change the plan year, you said?
You can change when the update is made. So when somebody moves, say, from a 25 to 29 to 30 to 34, have that only happen once a year, and that's at open enrollment.
Okay, I got you, okay.
People online can't hear you.
Give me the box. Okay, hello, people online. Have you seen an increase in medical professionals who only accept cash?
Yes.
An increase?
An increase
Yes.
of those? And-
We love them.
Okay, and do you?
Use them.
Well, great. I'm going to ask you about those who provide holistic medicine.
Now, it's still going to be subject to normal plan coverage, and so depending on what you're actually getting done, it might be excluded. But just because your physician is a cash-only physician, my physician here in Oklahoma City is a cash-only physician. She celebrated wholeheartedly when she fired her last carrier. But yeah, I pay her cash, credit card, or whatever, and she prints me out a claim form, and I send it in to the claims department, like back in the Stone Age.
Okay.
And the way the plan pays it at, like it's in network, because if you all, this is kind of the crazy logic. I hope that now with this question, I hope maybe all the pieces will fit together for everybody, is, we don't, the in-network benefits and the out-of-network benefits are exactly the same, right? We don't have a lesser benefit because you go out of network. But if you go out of network, we do have to hold the pricing to something, so that's where we use the reference, the Medicare Plus pricing. So for my cash-only physician, I pay them cash, I submit my claim to the claims department. As long as that medical provider charges within the 120% of Medicare, it's paid like any other network provider, and I get a check back from the plan for my entire office visit minus my office visit copay. So yeah, that's a great question. We should have had that as a topic here. Is everybody kind of following that? I mean, has anybody else encountered a physician that's just had it with insurance and just is a cash-only physician now?
Can't do it in a rural area. We wish we could.
Yeah. There's more and more of them. We're seeing more and more of them in Texas, more and more of them in Oklahoma, and I think that trend will continue.
Okay, and then how about full body scans? A lot of our employees get these letters from churches or something that says they're going to be a truck in, there will be a truck in town, and they will do a full body scan and tell you whatever you have wrong with you as long as you seek treatment. Is that going to be covered?
No, because there's no injury or illness. There's no diet.
So it's not preventative.
No. A full body scan is not an ACA mandated benefit at this time. So.
Okay. And then I'll pass the box, but I have one more question. Yeah. How does medical marijuana play into our
I knew we were getting out of this without that question.
You're welcome.
Yes, thank you. We were talking about that at the CBAO board meeting. The medical marijuana question is obviously it's a challenging topic for you bankers. I know you guys are going to seminars on it from your side of the mirror all the time. The official position of Advantage Health Plans is that we don't have official position on it yet. But I will, and again, I'm not the ruler here. This would be something that I would present to the board, and they would make the final decision on. But kind of what I'm just right off the cuff here, so don't hold me to it. But kind of where I'm looking at this is, Obviously, just because you send in a prescription that you got a doc to say you need medical marijuana, that's not going to be something that's going to be covered. However, if we can get some medical documentation that you have a condition in which you are getting treatment for today that is covered under the plan, and this medical marijuana has been FDA approved to treat the particular condition that you're receiving treatment on, and that medical marijuana treatment is the same or lower cost than your current treatment, I don't see why the plan would not want to extend coverage for that. If we can get somebody off of a $4,000 a month specialty medication to get them onto a $100 a month marijuana, I mean, I think that's prudent plan management. But it's going to be done if it is done, it'll be done in a really managed, highly managed, and kind of a case managed facts and circumstances case.
And some of that, you got to keep in mind that there's a discrepancy between the federal law and the state law.
That's got to change, yeah. Or the FDA is never going to approve it until that happens, so it's moot.
The plan is an ERISA plan subject to the federal laws. So we've got to kind of figure out where they're going to land. And it looks like the feds it looks like they're kind of moving the needle towards just allowing, because there are so many states that have, and I haven't seen any executive order or legislation just yet, but I think there's going to be some movement at the federal level to kind of neutralize some of this stuff, and what they decide is going to be impactful to a decision that the trustees would make.
Yes, Sal. It's a no until it's federal, yes. No until it's federal.
It's a no until it's yes.
Yeah. Now, of course, my cynic hat, if I'm wearing my cynical hat, I think by the time it becomes FDA approved and the drug companies get a hold of it, it won't be any cheaper than that $4,000 specialty drug, and that's my cynical hat. So, okay, next slide. We're done. We're almost done here, folks. Winner? Who? Me? I think we do have, we're going to be drawing 2 winners for the Healthcare Bluebook Challenge, and I believe each one of these is for $300 cash. Yes. So some lucky banker went out to Healthcare Bluebook, completed the challenge, and became eligible for this. And so Melissa is going to draw a couple of names from our fish-like bowl.
Yeah, so we had about 250 or so employees that participated in the challenge. So
Teresa, you want to toss that?
If you had an employee that participated in the challenge, their name is entered into this glass bowl. I think I have one in my hand. I want to make sure before I pull it out. Deidre Loosemore at Anchor D Bank is the winner of the individual.
All right.
And then we also did a second drawing. The individuals that are entered into this drawing are the individuals at the bank that had the highest percentage of participation with their employees. So I'm laughing because Anchor D Bank had the highest percentage of participation with their employees. They actually had 100% participation. So all of their employees enrolled in the plan participated in the challenge, which was awesome. So these are the Anchor D Bank employees.
Anchor D Bank is an all-around winner.
And Trey Freeman is the winner of that prize.
Right on.
That's it. Congratulations.
Very good. Do you all like these kind of things, these kind of challenges? Yeah, so. All right. Okay, one last thing. Early Christmas, everybody's going to be getting, you're going to be getting a supply of these at your bank. I don't know when, soon. These are ID card sleeves. We've started using these with our non-bank clients, and the employees like them. They're great reminders. So your hospital ID card, your Advanced Health Plan's hospital ID card, You'll be getting a sleeve. If the employee wants to store their hospital ID card in one of these sleeves, it's as easy as 1, 2 free. Just another reminder about using KPP. So, yep. So those will be out, and just make sure that, you know, if something you want to get your employees, it is an easy reminder. And then last, you know, keep up the good work, everybody. You guys have done wonderful. We're really, really happy with the results. The buy-in continues to grow, and please, you know, we're here to help. And I know that your board wants to hear feedback from you all. If there's anything that's working or not working in the plan, you can certainly call the Kempton team. But if you want to call one of your fellow bankers, I know they'd love to talk to you. So with all that, I hope some of y'all are going to stay for the Community Bankers Association conference. I think I have a cocktail reception that's starting here in about 6 o'clock, I think, right? 6 o'clock. So we've got about an hour. But anyway, everybody drive safe, and thank y'all so much for your continued support.